Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 29th, 2014. The market shifted into bullish volatile conditions on Friday. On an annual basis, using weekly RSI 14, the market's at 64 out of 100, high end and neutral. Using the 10-day NDX short-term market assessment, we're lower end of neutral at 31 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is at 6.93%, so we're about 5% away from sideways conditions. Slope of the 50-day moving average weakened into red bearish at 0.13%. ADX declined to 0.13%, so no trend to speak of, basically a choppy market. The ATR percentage, looking at the last 100 days, is volatile at 1.11%. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. It's exactly at 1.0 for risk on. If you take that score of 1.0 and compare it to the last 5,000 days, find the z-score. It's at minus 0.03. You can see the time series here in this histogram. And so we just had a minor local minimum here at minus 0.5 and is now just right at the break-even line. And so we're looking for a potential continued decrease in volatility here. For this to continue into the positive side, that would lead us towards looking at XIV. This week we'll be adjusting the BMR. You can see last month's holdings here. And these are the current leaders as of the close on Friday. ETF 13, it's U.S. real estate treasuries and Australia. ETF 22, it's utilities, healthcare, and real estate. ETF 32, it's agriculture, utilities, and healthcare. And these are the leaders from each of these three respective populations using the BMR methodology. In ETF 2, the theoretical exposure is at 70%. The model portfolio itself is at 80%. This is just a quick look at the different BMR portfolios. I'll just let you scroll through that. Next up is the market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. The purple line horizontal is the swing high at about 186. I'm sorry, 188. The horizontal red lines are price levels that have held as support and resistance in previous trends. Dark blue shaded area is the 30-period Bollinger Band plus or minus 1 SD. That's the river. The lighter blue shaded area is the floodplain. That's the 30-period Bollinger Band plus or minus 2. The reddish shaded area is the dragon. That's the 10-period Bollinger Band plus or minus 0.5. That gives us the early alerts into changes in direction of the river. And you can see right now we've been in a choppy sideways market here for about 15 days, with price holding right at the Bollinger Band mean now. The river slope is still up, but we've had about 15 days of sideways chop. The last time we saw that kind of condition was here in at the end of December, start of January, and the market voted down with about a 4% sell-off. And then the previous time before that, the market was choppy in here in the end of November, beginning of December, when it responded with about a 3% gain. So it's not predictive, but we are looking at this as developing a sideways quiet channel condition. There's three Bollinger Band, regression channels marked off on this, RAF regression channels. The short term is the 10 period, that's the blue channel. Intermediate is the 30 period, lagged by a day, that's the black channel. And then the long term is the 90 day, which is the green channel. The green and the black are both sloping up, almost parallel. The 10 is showing a bit of a pullback. And so, as the read on this is a market that is perfectly balanced to go in either direction. This is a basing price level here. No burning urgency for people to keep buying it. But then again, all the selling pressure, which evidenced by the big red candles, have been offset by tall white candles. So it looks like a lot of program trading and markets settling in around fair value here. You can see that the slope of the 30 period regression line, that's noted by this thin sine wave looking indicator here, has almost come back to the zero line. And it peaked up here at about 0.40. It bottomed out here around minus 0.275. And those really are historically steep up and steep down demarcations for that time series on the slope value. So we're coming back to something like a normal level here. So this sets up a market that's perfectly well prepared to go in any direction. I have marked off this area here in yellow as the prices at which where I am taking my intraday direction really from the direction the price takes that day. I don't have a bias on the long side or the short side. Right now, it would take a failure out of the floodplain around below 182 to cause me to have a downside bias, and it would take a breakout above 188 or a new all-time high to give me a automatic long side bias. In the meantime, while we're in this yellow zone between the shores of the two floodplains, I am basically intraday bias neutral, but ready to reinforce in the direction that price is unfolding. The jaws of PPO are open to the downside still, warning us about weakness. And you can infer that from failure to follow through. We haven't seen the persistent pattern of selling yet, such as we saw back here in January. All right, so moving on. 3 of the 10 regional indexes are on cash signals, so that puts us at 70-30 cash to or invested to cash. A slight improvement week over week. The S&P is still better than EFA. The S&P at 50 is better than EFA. The global's at 48. Inside the U.S., the strength is in the mid caps, then large caps, then technology, then the small caps. Two strongest sectors are the mids and the large caps of the U.S. Two weakest sectors, emerging markets and Japan. World market model, again, you see everything in the U.S. is above average except the Dow, which is below. Japan, very weak. Asia, weak. And then in Asia, it's only really Vietnam and Indonesia really standing out. Philippines, India, Australia, and China above average. Extreme weakness in the rest of the Western Hemisphere, excluding Canada. Strength in Europe, led by Spain, France, Belgium, Switzerland, and Sweden. The alternate asset class is still doing well. The ETF top 30 based on the ETF2 rule set. Those that are green in strength and white in consistency are newly emerging leaders because consistency is a 10-week rolling average of the strength rating. And so those are the new emerging leaders. So Indonesia, India, more Indonesia, agriculture, Nifty 50 India, all of those looking like reasonable places to explore. Same lens on the Dow. Strength is in Merck, Caterpillar, Microsoft, Disney. Weakness in Chevron, Nike, Boeing, Travelers, and Goldman Sachs. They are all recent weakness because they are red and then yellow. In the same way that Microsoft is moving to the top here with green and then white, as is United Health, green and then white. So the strength is a shorter term phenomenon. All right, shifting to the daily report. All right. Long signals from the overreaction system for technology and small caps. Same in the channeling. We've got channeling and overreaction signals for Nike, Verizon, and Home Depot has a channeling. Small caps with the 5DD. 551Ws in Basic Materials, Technology, Finance, and American Express. And then these in the auto framer all test out better than 2 to 1 on reward to risk ratio using mechanical entries, exits, and then profit targets at the 10-day high. Quick look at the tactical summary. I'll let you just review. Not much to choose from, although I do notice Visa is number 2 on the max pain range compression, has a 3.3 to 1 on the auto framer, and is both a channeling and an overreaction, and a score of 2 on the RSI 2. Among the ETFs, more signals to choose from, including a handful of 551Ws and RSI 2 value signals in Russell small caps and in gold. The auto framer. This is based on strictly trade location, based on a mechanical entry 5 cents above yesterday's high, with a stop 5 cents below yesterday's low as the risk, and then a retest of the 10-day high as the profit. And so there's, again, quite a few to choose from. I'm showing symbols from the Dow 30, the ETF 30, and the ETF 200. And I'll just flash through the couple more slides for your review. So that's everything from Tortoise Capital for the weekend. Keep your risk measured and your powder dry. We have a market that is poised on a knife edge here in the middle of that price action. Wouldn't surprise me to see a few head fakes before we get some price action here. But the longer we stay in this sideways quiet channel, the bigger that next breakout's going to be. So it behooves us to be ready with our market leaders and then our favorably positioned symbols based on trade location. So take good care. We'll see you in the chat room.